In chemistry, a reaction only happens when the conditions are right. It's no different in real estate. Welcome to the Alkaline Reaction, a podcast from Alkaline Advisors, where we break down the deals, partners, and capital structures that turn opportunities into outcomes. I'm Spencer Carenti, and today's reaction, preferred equity. Preferred equity is one of the most misunderstood capital positions in real estate. It's not debt, and it's not common equity. Instead, preferred equity sits between senior debt and common equity in the capital stack. This positioning matters because it changes who gets paid, when they get paid, and how risk is distributed across a deal. Preferred equity typically receives a preferred return. That return is paid before common equity participates. In exchange, preferred investors accept limited control and limited upside, but receive stronger downside protection. So who uses preferred equity? Preferred equity is most commonly used by institutional investors, family offices, credit-focused funds, and sophisticated private investors who prioritize risk-adjusted returns over maximum upside. On the other side, operators use preferred equity when senior debt is no longer sufficient or when raising more common equity would be too dilutive. Preferred equity becomes a solution, not a compromise. To understand how preferred equity works, it's important to understand what it is designed to do. Preferred equity is not designed to chase returns. It is designed to manage risk. Preferred equity structures often include a fixed or structured return, priority cash flow, protective rights such as approval authority, cash flow controls or step-in remedies, and in some cases, limited participation in upside performance once certain thresholds are met. Now let's look at how this works in real transactions. Scenario 1, a stabilized multifamily acquisition. The asset is strong, occupancy is stable, but interest rates have moved, and senior debt only covers about 60% of the purchase price. The operator faces a decision: raise a large amount of common equity and dilute ownership, or introduce preferred equity to bridge the gap. In this scenario, preferred equity fills approximately 20% of the capital stack. The preferred investor receives a 9% current pay preferred return. Distributions are paid quarterly from operating cash flow. In addition, the preferred investor receives limited upside participation if performance exceeds a defined hurdle. The outcome is alignment. The operator preserves control and limits dilution. The preferred investor receives priority cash flow and downside protection. The deal closes because the structure matches the environment. Now, consider a very different situation. Scenario 2, a transitional mixed-use redevelopment. This deal carries higher execution risk, longer timelines, and greater exposure to market conditions. Senior debt covers only about 55% of total capitalization. Raising all remaining capital as common equity would expose the sponsor to excessive risk. Once again, preferred equity fills the gap, this time at approximately 25% of the capital stack. But the structure is different. The preferred return accrues rather than paying current income. Control rights are stronger. Cash flow sweeps are triggered if performance declines. The preferred investor is underwriting to the exit, not interim yield. In this scenario, preferred equity is not about income. It is about protection, visibility, and control. The difference between these two scenarios highlights an important truth. Preferred equity is not a shortcut. It is a precision tool. When structured correctly, preferred equity aligns capital, operators, and risk with reality. When structured poorly, it exposes weakness in assumptions. Preferred equity is neither good nor bad by default. Its success depends on clarity, discipline, and alignment. That's today's reaction. If you found this episode helpful, please subscribe and join us next time as we continue breaking down the commercial real estate industry. I'm Spencer Carenti, and thank you for your time.